All right, yield nerds, I am very excited about this episode because I will be reading tea leaves in front of the New York Stock Exchange. But lucky for me, I don't have to read it myself. I will be relying on a market strategy published by a financial legend, and I'm going to share who that is and more about it coming right now. Well, we're up to 459 subscribers. Thank you for your support. If you're new to the show, feel free to use the three playlists. One of them, the roadmap, lists this show in chronological order. More importantly, please remember that I make mistakes. I admit most of them that I remember, and there may be others I don't remember. Do your own research. Well, this episode is in four parts, as are most episodes. The very first one, I will show you the market temperature of my portfolio versus the market at large, NASDAQ in particular. And then I'm going to share a remarkable research paper from Deutsche Bank that lays out how the Fed could possibly act and what you can do based on it. I learned a lot from it. And then my investment thesis based on the Deutsche Bank research and my holdings. Well, the some of this my portfolio is mainly fixed income. My portfolio barely notices what's going on in the market, while the Nasdaq has crashed and burned, and that has been true of the Dow and the S&P as well. So overall, I am smashing the market by 12%. And in the meanwhile, I do have an equity allocation that initially took a beating after being far ahead of the market. This was Cal-Maine Foods letting me down. Cal-Maine, you too, Brutus. And once I got out of Cal-Maine, I have indeed rethought my portfolio using a lot of inputs, including the Deutsche Bank paper we'll talk about, and I am back to smashing the NASDAQ, and my returns are inching back to the positive side for the year, which is pretty good considering the market is down 12% just this year. Well, so let me quickly remind you that all of my equities account for 1% of my portfolio, so I can make these grandiose comments. I don't risk too much on the equities at this time. So my strategy that I outlined earlier, I just keep selling every time my equities reach a profit. Sometimes I make more money, sometimes I make less money. I do eliminate a couple of these from here and there, but I want to get to the meat of today, which is this phenomenal article by the angelic Deutsche Bank analysts. And I want to let you know the power of this article could floor you. And let me share more. And before I share more, I want to make sure you know that I am not a wealth management advisor. This is not tax advice, and I don't do politics, and I'm not selling t-shirts or snake oil. So, hey, you may remember my perspective on the market is that, for the past month and leading into March 20th, we have a very frothy market. There is this tariff, no tariff, government shutdown. Thankfully, that didn't happen. The Middle East war, the Ukraine war. So I mainly thought there's going to be a lot of uncertainty and that will stress the markets. And that was one of the reasons I sold off most of my equities and went to 1% allocation. Except I did not read the guidance from Deutsche Bank. And this opened my eyes. The Deutsche Bank article, and there is a link in the video description, please feel free to consult it. The Deutsche Bank article says, how should the Fed respond to an economy in transition? And it said, hey, the economy is facing a complex transition. And so they asked Deutsche Bank analysts, how are you going to do it? This is investing.com, a very, very reputable article. And I was looking for direction. And I got to tell you, they said, motivated by the emergence of recession fears, the market is going to be a more dovish Fed. Here's what that means. Whoa, whoa, whoa. If the Fed is going to decrease interest rates, then I got to increase duration and capture those higher interest rates right away because this is a big deal. Thank you, Deutsche Bank, for the guidance. And then I read the next paragraph that said, hey, hold on a second. Deutsche Bank, however, believes that interest rates will remain steady for the rest of the year. And so, hold on. So, I guess what I'm hearing is interest rates are going to be steady, so I should just stay in short term. So I was a little confused there. Now I know interest rates are going to be steady; they're not going to decrease. And then I read the article more, and Deutsche Bank says, hold on a second, on the hawkish side, with this undeniably solid economy and CEO confidence, interest rates could actually increase. So I guess I should sell long-term bonds. So I kind of got very confused by this time. It looks like Deutsche Bank is saying a lot of things. So I was looking for the conclusion of this extraordinary article because Deutsche Bank does see the future very clearly. And so Deutsche Bank ultimately said, we see two possibilities. The possibilities we see are rates will either increase or decrease, and the base case is they're going to stay flat. Thank you, Deutsche Bank. I was looking for clarity. Now that I know they're going to stay flat and they could increase or decrease, that greatly informs my strategy. Well, with that kind of clarity, I am now able to form my own investment thesis. And so my investment thesis is very simple. I see the market crashing in certain areas. And so I look for stocks with very steady growth and fundamentals. What do I mean by that? I don't like debt-laden companies. Now remember, I am staying in fixed income and I am staying in short-term fixed income. That is the majority, vast majority of my portfolio. For that tiny amount, I am looking for stocks with a very steady growth and good fundamentals. And then when they crash, because there's a lot of volatility, I grab them. And I'm going to tell you which ones they are that I have my eye on. And my hope is that when there is another index rebalance that goes on, and index rebalancing happens once a quarter, and when there is another index rebalance that goes on, those stocks that are continuously increasing in revenue, profit, and EPS will go into the index. And the ones that don't have that straight line growth will get out of the index. It's that simple. And so, in my opinion, so please make your own decision. So what I look for is straight line growth. And let me give you some examples. Here is TW Trade Web. If you drew a line, that line would go straight up for earnings per share, straight up for revenue, straight up for cash flow. They don't have any debt, and their market cap is increasing as evidenced by the stock price going up, up, up. I picked up some trade web. Let me give you another example. Natera, I've talked about this stock before. They are going from making a big loss to a small loss to a small loss, and their revenue keeps going up. Their cash flow is trending towards positive. They have everything going for them. And thank you for a little bit of a stock price crash. So I grabbed Natera as well. Bank of the Ozarks is a dark horse. This is a bank with no debt. Their earnings per share continuously goes up. Their revenue continuously goes up. Their cash flow continuously goes up. And their stock crashed with the rest of the market. Thank you, market. I did pick up some Bank of the Ozarks. Let me give you another example. This is Manhattan Associates. I covered them in an earlier episode as well. Again, straight line earnings per share, revenue, and cash flow. And the CEO said something that kind of cost his own job. And there is a new CEO. And I like the crash in the stock price when the CEO gave that news saying, it's possible the rest of the year will be volatile. And there went the stock 30% crash. So I did pick it up. That's Manhattan Associates. The next is Dynatrace. If Arista Networks had a baby sister, that would be called Dynatrace. They are in the same business. Dynatrace serves a lot of European customers. Tariff, no tariff. Nobody is suddenly going to say we don't need our cloud investments to have no protection. So I feel good about Dynatrace, especially because they again exhibit this straight line increase. Their stock crashed with all of these tariff talk. And I just don't see how Europeans are going to say, we're not going to do any security. So I think they'll foot the cost. Maybe Dynatrace will give a little bit of discounts, but they are going to do well. In my opinion, you do your own research. So I picked up some Dynatrace. Delcath, Delcath. Delcath is in the oncology business. And as you can see for them as well, they're digging out of negative cash flow. They came up to positive cash flow and had a little bit of the blip, and the market punished them devastatingly. At the end of the day, their revenue is going up exponentially, phenomenal numbers there. And because of the blip in cash flow, they had to put some money in to turn the last quarter towards the right direction, invest in future growth, and their earnings per share went negative and their stock crashed. I like what I see here. I picked up some delcath as well. Idaho Strategic Resources is a gold mine. For real, they dig for gold in the United States. So, and they also look for rare metals. Given all of the global talks going on, I figured, hey, I got to own a local gold mine. They also have no debt, which is nice. Their earnings per share has already turned positive. Their revenue is going up. Gold prices are going up. Their cash flow is going up. So I like that smell there. This is Robinhood, and there is a lot of controversy around Robinhood. And as I told you, I don't do product and politics. I purely look for fundamentals. They are showing a straight line earnings, straight line revenue, straight line cash flow. I can do that, and thank you for the market crash. This is a little bit expensive, but at the end of the day, their weighting in the index will increase if they keep putting up numbers like this. So I picked up some Robinhood. So informed by Deutsche Bank, well, I'm kidding, I've beaten them up a lot. They usually come out with great research. The challenge in large institutions like Deutsche Bank is they have a lot of analysts, and you can ask three different people and they'll give three different results. And so, no pun intended towards Deutsche Bank, but my holdings are informed by my own research as I become angelic in front of the New York Stock Exchange and think about what I want to do. I'm not jumping into equities in a big way, but here are all the stocks that I just told you about: TradeWeb, Natera, Bank of the Ozarks, Delcath Systems, Idaho Strategic Resources, Robinhood, Manhattan Associates, and so on. And then I do have my dogs that have crashed, and I'm not selling much of this at a loss. I'm just going to sit on it. But at the end of the day, the proof is in the pudding. Even on a day like today, and today is March 17th. Even on a day like today, the market is barely up, or I like comparing myself to the NASDAQ because that has the best long-term results. The NASDAQ is down 0.3%. My portfolio is up for the day 1.3%. I'll take a performance like that any day. Thank you for watching Yield Nerd. The proof is in the pudding. As long as I keep beating the NASDAQ with those kinds of margins in the long run, I think I'll do okay. You do you. Even a broken clock is right twice a day. Don't trust me. Do your own research. And thank you for watching Yield Nerd.